Ever wondered how Warren Buffett, known as the Oracle of Omaha, made billions in the stock market? Truly, the tale of Warren Buffett is as fascinating as it is inspiring. Born in Omaha, Nebraska, Buffett was not your ordinary child. His early life was pretty much a preview of the financial prowess he would later develop. With a father who was a stockbroker, young Warren was introduced to the world of investing quite early. He bought his first stock when he was just 11 years old. Can you believe it? 11. Most of us were still playing with toys at that age, but Warren was already dipping his toes into the stock market. He bought shares in a company called City Service, and that was the start of his journey. His investment journey, starting with buying shares in a company at just 11 years old, shows his innate understanding of the market. And as we'll see, this was just the beginning of his remarkable career. Buffett didn't just stumble upon his wealth. He built it through smart, calculated decisions. His journey to becoming the Oracle of Omaha began with his education at Columbia Business School. Here, he was mentored by none other than the father of value investing himself, Benjamin Graham. Graham's teachings were instrumental in shaping Buffett's investment philosophy. To understand this, we need to delve into the concept of value investing. Value investing is a strategy where one seeks to invest in stocks that are undervalued by the market. The idea is to look for shares of companies that are priced less than their intrinsic value. This approach requires a discerning eye for potential, an understanding of business fundamentals, and above all, patience. Buffett didn't just learn this concept, he made it his guiding principle. He started applying it throughout his career, making investment decisions based on the underlying value of companies rather than market trends or short-term fluctuations. For Buffett, the stock market was not a speculative casino, but a marketplace for buying portions of businesses. He knew that the market could behave irrationally in the short term, overpricing or underpricing stocks. But in the long run, the true value of a company would always shine through. If the business was solid, its market price would eventually reflect its intrinsic value. This is why he would often say, "Price is what you pay, value is what you get." Buffett's approach to investing wasn't glamorous or exciting. It was methodical, disciplined, and at times contrarian. He didn't chase after hot stocks or jump on the latest investment trend. Instead, he looked for undervalued companies with a strong business model, good management, and a long-term competitive advantage. So, let's take away Buffett's first crucial piece of advice. Invest in undervalued companies that have a solid business model. This is the cornerstone of the Buffett way, a path that has led him to become one of the most successful investors of all time. In 1965, Buffett's investment strategy took a significant turn. He bought a textile company, Berkshire Hathaway. An unexpected move, many would say, considering the company was struggling at the time. Yet it was this very decision that would solidify Buffett's place in the annals of investment history. Berkshire Hathaway, once a faltering textile company, would become an impressive holding company under Buffett's guidance. Buffett did not simply buy a company. He bought into a philosophy. The philosophy of long-term investment, of value creation, and of strong leadership. Buffett looked past the immediate issues plaguing Berkshire Hathaway and saw potential. He saw a company that, given the right management and direction, could flourish. With Buffett at the helm, Berkshire Hathaway began to diversify. It started acquiring shares in media, insurance, and energy companies. It expanded into retail, manufacturing, and services. The once struggling textile company began to turn a profit, and not just a modest one. Berkshire Hathaway became a titan of industry, a beacon of successful investment. The transformation of Berkshire Hathaway was not an overnight phenomenon. It was the result of careful planning, strategic investment, and an unwavering belief in the company's potential. Buffett's strategy was not to buy and sell for quick profit. Instead, he focused on the long-term prospects of a company. He looked for businesses with strong management teams that had a clear vision for the future. In the world of investing, Buffett's approach was revolutionary. It challenged the conventional wisdom of quick returns and short-term gains. It emphasized the importance of patience, of staying the course even when the market fluctuated. The story of Berkshire Hathaway is a testament to this approach. Under Buffett's guidance, the company grew from a struggling textile company to a holding company with a market cap exceeding several $100 billion. And so, we come to Buffett's second piece of advice. Look for companies with strong leadership and a bright future. This principle, demonstrated so clearly in the transformation of Berkshire Hathaway, is a cornerstone of Buffett's investment strategy. It's not just about the numbers on the balance sheet. It's about the people leading the company and the vision they have for its future. Warren Buffett is not a man in a hurry, and his investment strategy reflects this. The Oracle of Omaha is a firm believer in the power of patience. His buy and hold strategy isn't just a catchy phrase. It's a principle that has been at the heart of his investment philosophy for decades. Buffett's approach to investing is akin to planting an apple seed and waiting for it to grow into a tree. It's about nurturing that seed, tending to it, and having the patience to wait for the tree to bear fruit. It's not about the thrill of the quick flip or the allure of instant gratification. It's about understanding that time is an investor's best friend. This long-term approach has allowed Buffett to weather economic storms, resist market hysteria, and come out on top. He doesn't chase trends or get swept up in the frenzy of the latest hot stock. Instead, he waits. He waits for the right opportunity, for the right company, at the right price. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." It's this patience, this willingness to wait, that has been his greatest asset. It's a testament to the power of long-term investing and a reminder to all of us that good things come to those who wait. Buffett's third piece of advice: investing is a marathon, not a sprint. Patience is key. So, what can we take away from Buffett's investment journey? Well, it all boils down to three key principles that have been the foundation of his phenomenal success. First, investing in undervalued companies. Buffett's keen knack for spotting undervalued stocks has been a significant factor in his success. He doesn't just look at the current price, but the intrinsic value of the company. He understands that a company's worth is more than its current market price. It's about the potential growth, the underlying assets, and the ability to generate revenue in the long run. Second, the importance of strong leadership. Buffett firmly believes in investing in companies led by competent and trustworthy leaders. He often emphasizes the significance of management integrity and capability. To him, a business with a mediocre product but excellent management is far superior to a business with an excellent product but mediocre management. And finally, patience. Perhaps one of the most crucial lessons we can learn from Warren Buffett is the virtue of patience. Investing isn't about making quick bucks. It's a long-term game. Buffett's buy and hold strategy demonstrates his belief in the power of compounding and the ability to weather market downturns. In the words of Warren Buffett himself, "Price is what you pay, value is what you get." Remember this, and you're well on your way to investing success.